Surprise rocket launch? No one was saying it last week, but it could happen to stocks. In reviewing the market commentary after last week's generally positive number in terms of stock performance as well as the economic news saying buy, buy, buy. But that is not the case, at least in what I was seeing. Of course, everyone is always worried about the deficit, which will be a problem at some point, likely. Any number of things, and those of you who followed my writing in Forbes know that I've commented in the past about, the commentary that encourages you not to invest as opposed to investing. And certainly the technical studies since the October 22 low have been bullish. One of the questions I often get is, well, you sure this isn't the start of a bear market? In my advanced decline line course, I usually start off with the formation of the top in October of 2007. This is a chart of the New York Composite and shows we made a high in July, and from that we started having concerns about a couple of hedge fund housing market crashed, and we got below the Stark band here in the middle of August, and then we started a rebound. By September I was looking for problems ahead, and others were looking like, oh, no problem with the housing market. But as is often the case, the NYSE AD line, it peaked here in late May, then in July, so it peaked here, then in July made another new low, and then in October made a much lower low, and then eventually violated the support. You also saw divergences if you looked at the daily and the monthly AD line. Certainly we don't see that at this point. This weekly chart of the SPY shows that we really had a strong week. We've been consolidating here for a month, at the yearly R1 level, which is at 641.98. But then last week closed up 1.5%, and it looks like the Stark band here is at 679, 680, and then we have the R2 resistance at 695.52. 7,000 number in the S&P would definitely shake the markets and would probably stir some of those folks who've been on the sidelines since the decline in early April. They might even be forced to buy. Obviously, their jobs depend on them being on the right side eventually. So I don't think that's the case right now. You can see the AD lines. The S&P, has been declining. So it's not made a new high in the last month. The stocks only AD line has, and of course, look at the NYSE All has made a significant new high. Well, some of you probably know this is the one I've been following since the 80s, and it's a broad measure, stocks, bond, funds, etc. So that was a pretty strong signal. The divergence was even evident last week in the daily charts. We have a SPY chart here, and you can see that this is as of the 9th, Tuesday. You can see the AD lines were starting to diverge already. The S&P had made lower highs here at that point, and stocks only did better. NYSE on a daily basis was looking even better. So let's advance it. Okay, so this is as of the 10th, and another day. Okay, sharply higher. This was the kind of the kickoff that said, okay, well, it's very likely that the Fed's going to cut rates next week. You can see even the AD line on the S&P finally made a new high, as did the stocks only AD line turned sharply. But look at the NYSE, it was surging to the upside. So that was a sort of a tough call, but I gave the NYSE the benefit of the doubt. I've never seen quite this sort of difference in the 80 lines, but it's been unclear, I always default to the weekly or the monthly, and they were saying the market can still go higher. If we click it forward to Friday's action, you can see the S&P turned down sharply, as did the stocks only, while the NYSE is still within this positive trend. In terms of Friday's close, once again, I'll take a dip at the stock charts close market summary data. You can see on Friday it was really much the utilities, the NASDAQ Composite, the NASDAQ 100, and the S&P 100 were the bright spots. Pretty much everything else was lower, led once again by the small and mid caps, who were the strong ones earlier in the week. This disparity can also be seen in this performance chart, one I like to use for not only market analysis but also finding out what to buy or sell. So this is a comparative going back to the early June. Leading the pack in purple is the Russell 2000, followed closely behind in green of the XLK, the technology sector, then blue in the QQQ, and finally the SPY in red. So you can see that the leadership here, and one of the ones I recommended, XLK, at the start of the week, is that that this action is quite bullish. Certainly the reversal on Friday makes an entry a little bit more favorable than it was earlier in the week in the small caps. So I'll probably take a look on Monday. Finding good positions in the ETFs has been more difficult in the past few weeks, not in stocks. So I thought really don't talk about the hot stocks, but you can see here's Apple. This is the portfolio as of last Friday. We got back into Apple. We were a little nervous before, so it sold out of half of it, about break even, but still up nicely, 11%. The big winner here is OTEX. Uber is kind of generally climbing along. You can give the percentages here, and Green Brick Partners and Element Solutions were a couple, along with Palantir, that was just recently added. These are the charts of the individual positions that are part of the weekly and stock report. Allows you to, stock charts member can just click on these. OTEX, I recommended selling half the position on the open. I was bought right on this pullback here, like 29.98 or something, and it had a great move, but it was already getting above the R1. It was above the R2 last month, and also reached the R1 or the R2 in before we bought it. So it's getting a little frothy up here. So we took a nice profit, which is also the case. No real signs here yet of a top. If we do that, I'll probably adjust the wide spot in the rest of the position. This is what the stocks report looks like. We have weekly doji buy signals and buy scan stocks. You can see I have the quarterly, the monthly, the weekly DTS, and the 3. All of these, of course, have positive DTS, and you want to see, watching some of these, whether they're going to move into 3-day sells as well. Sell scans helps you if you have a position I don't like. At least you can see this is the objective AI version, and then gets into the charts of the individuals. We just saw how, and I also provide some extra information. This is a peek in at Jerry's new doji scan list, which we're reviewing. As I commented in my weekend post to Forbes, AD numbers were not very strong on Friday on a daily basis. Here, this is a 90% chart. You can see that on Thursday, almost close to 80% of the S&P stocks were higher. 54% were lower on Friday. Small caps, also gave up much of their profits. The dichotomy was not really as strong in the NASDAQ, and there are signs from the RS analysis that suggest that the Qs may be ready to lead again. Before I get to the Qs, we'll look at this daily chart the New York Composite, you can see it's really up towards the Stark bands. AD line is well above its rising moving average, and if we add in the pivots here, I think we'll see that we've reached the R1. The R2 is at 21,890. So market closed at 21,374. So another 800 points on the upside would take you to the R2. And of course, if we quickly convert this into a weekly chart, we'll get those pivot levels as well. I really encourage when I teach about pivots, get an idea of the markets you're trading and watch those levels. So, like the S&P, we're bumping into that R1 on a yearly basis. Remember the key is back in April, before the, many were in the market, it closed back above its yearly pivot, at about 18,650. So you would have caught most of this move, and look at the AD line is rocketed to the upside. Looks quite strong. Not a lot of warning signs still. You can see this is a chart of the VIX and the VXN, both still below resistance. They moved above their moving average at the end of August, back below them now. So, gets above 17 here in the VIX, 17.5. That'd be, you'd say watch the next couple of days, watch some of the other technical studies. A break of this downtrend and the start of a new uptrend is really needed before we're going to conclude that is bearish for stocks. New high, new low analysis, still looking pretty good. You can see the new highs on the NYSE spiked to a higher high above 200 on Thursday. No warning signs from the new lows. That's consistent with the NASDAQ numbers. You can see almost to 500 on Thursday. A few asked me why I hadn't been in the small caps recently, and this is pretty much the reason. It's the AD line, looked pretty good, back in May, but really has underperformed since then. If you look at the, compare this AD line to the action in the QQQs, you'll see what I mean. So, formed a doji, no doji sell signal. That'd have to come this next week. If we get back down into the 110 level, this is on the IJR, I'd be a little more interested, with a stop, under 107, say. But so far, we haven't gotten that opportunity. The weekly chart of the Qs still looks positive. Breakout here of that range, a new high. The AD line on a weekly basis is lagging. You can see it's sort of formed a divergence here about a month. Typically, those sort of divergences are not indicative of 8 to 10% pullback, but do allow for a 3 to 4 cent. Of course, we're at new highs now. RS is looking a little bit better here. So, but we would, and the fact that the moving average on the AD line is rising, that's not consistent with the top. Switching here to a daily chart, it looks a little more troublesome. We have a pattern of lower highs here in the divergence. So the 20 period EMA is at 575.55. So, we're about 10 points above that. Below its moving average here, if you were to see a break below these lows, that would suggest we are going to see a deeper correction, possibly down, to the S1 here at 553. Heavy support at 536, which corresponds to the February peak. So let's run through the ETF weekly report and watch lists. You can see new weekly buy signals on the utilities. We've held into our position there, and they had a nice rebound this week. So I'll be watching it and looking at some of the indicators. Maybe it might be a time to add. Looking at growth is still leading. And that's still a positive. We'll maybe show you the IWF. I think was up 2% over 2% last week. That's the growth. And the IWD was just up fractionally. So still favor, being the leveraged long, and not out of the leverage short at this point. This chart is of the SPXL triple leveraged on the S&P. You can see we had a nice buy signal back in here, and it's been doing pretty good. This is the 260 minute, so we've had a couple of pretty good shakeouts here. So it's not for the faint of hearted. So the pivot we're watching 192, and if you aren't using pivots, learn about them. Here's a breakdown. I really look for, so the sectors look the most interesting are XLE, XLI we got out of, and it's really cratered. XLY still looks pretty good, but it's gotten down to 58% positive. So it needs to prove itself on the upside. Holding in XLP is not doing anything positive for us and not really doing anything negative. So it's sort of a defensive play. XLV I'm watching pretty closely. XLK you can see is very low. XLC of course has been moving sharply higher, and in terms of the week, XLK was up 3.1%, XLU was up 2.4%, XLC was up 2.3%, and the S&P was only up 1.6%. 3 months, XLC has been one of my favorites, and it's up 13.5%. While XLY and XLK were up closer to 12%. So, new signals, just the ones I described. You can see that there's not a lot of, we have a negative DTS on S&P oil and gas exploration. We established position in this one last couple of weeks. Also in gold, but not a lot until you get down into some of the ultra short and the XLP. So, the relative performance is pretty interesting. So, we were looking at, we said it had to prove itself on the XLK. It has done that. So, and needs to have further gains. Communications also still looks positive. So it's a ways away based on the, so what we look at here is the slow and blue, the fast. So we look for, just like a stock chart, start to look at the fast here moving above the slow like it did in middle of August, and that caught a good run in the XLC. Energy starting to look like it's bottoming. It's broke this downtrend, moved above this higher peak here, but now it needs a strong move to the upside to complete the bottom formation. Also iffy at this point is healthcare. You can see it's just sort of it appears to have broken its downtrend here and just kind of holding. I want to see it move above these last couple of peaks to validate my bullishness in healthcare. And here are the healthcare holdings. All doing quite good. And we put a new speculative position on in the TQQQ, which is up from where we got it, but it's not performing as well as it has in the past. XLY, you can see XLC, it's been a good month so far, and we're still holding GLD, and EFA, it's back to the highs here. So I'm watching this, and ITB, had another new high and then a pullback. So I'm kind of looking at the 120 to 122 area to take some profits there. We've been in it since for quite a while. Important economic data next week, of course, focusing on the FOMC on Tuesday and the long-awaited press conference. I think he'll probably cut a quarter. He could cut a 0.5% given some of the stuff we're looking at in the jobless claims, which moved sharply higher, to last week. So, we also got retail sales, Empire State Manufacturing, housing starts, building permits, Philadelphia, Fed manufacturing. So it's going to be a pretty full week. If you aren't a subscriber, I'd encourage you to subscribe to either of the publications. That's what keeps these videos going. And one little added tidbit that shows you what I was talking about in terms of the jobless claims suggests a slowing of the economy. Of course, that's going to be should spur the Fed to doing more, but that market wrap has all sorts of stuff. Move all the way down, and you can kind of see some stuff that my old friend John Murphy put together on intermarket, other assets, economic. So here, look at the so here's the PPI, the CPI, both have turned up slightly. And let's look here at the unemployment. Okay, look at this chart, goes down, to 2016. Doesn't really tell you much, but then what I'd suggest you do is maybe a slight uptrend here, and if you go in there and you say, okay, we're looking at 10 years, let's look at 5 years. Okay, a more significant uptrend. And of course, if you go down to say 2 years, you can see why the Fed might be worried. Pretty significant breakout. So don't see any real signs of recession yet, but a lot of people are warning about them. Typically those folks are early. If you're trying to follow someone, myself included, and you think that their approach makes sense, look back at what they were seeing at other critical turning points. Were they worried about a bear market in the last 15 years? I haven't been. So go to the Viper Report. We'll put some new articles up, and hope you have a good week of trading. Thank you.